At 24, Leopold Aschenbrenner looked like the man who had seen the future before everyone else. A former OpenAI researcher, he had written a 165-page manifesto arguing that artificial intelligence would reshape the world within years. Silicon Valley listened. Investors handed him billions, and his hedge fund, Situational Awareness, made an explosive bet on the call. Pennies powering the AI revolution, memory chips, data centers, electricity, and computing infrastructure. For a while, he seemed unstoppable. The fund produced extraordinary gains, attracted tens of billions of dollars, and turned Leopold into Wall Street's newest genius. But genius was not the only force behind those returns. According to reports discussed after the collapse, the fund may have been running at roughly 4 times leverage. That meant every dollar of investor capital controlled about $4 of assets. The mathematics was brutal. If the portfolio fell by around 25%, the fund's equity could effectively disappear. Then the AI trade reversed. Stocks that had risen together began falling together. Losses arrived across multiple positions. The fund also held private investments, including a major stake in Anthropic. But private shares could not be sold with the click of a button. The assets that appeared most valuable on paper became almost useless when immediate cash was needed. Banks demanded more collateral. Leopold reportedly searched for buyers. But once Wall Street realized that the giant fund had become a forced seller, the market changed from an auction into a hunt. Other traders began selling and shorting the same stocks. Potential buyers stepped back, waiting for lower prices. Every decline created another margin call, and every margin call forced another sale. The fund was no longer trading the market. The market was trading the fund. Finally, Citadel stepped in and bought much of the public portfolio at distressed prices. The young fund manager, who had predicted the AI boom, was forced to surrender his positions near the bottom, while a stronger institution gained the ability to wait for a recovery. That is the real lesson of this story. Leopold may not have been wrong about artificial intelligence. Some of the stocks later rebounded. His mistake was building a position that required the market to agree with him immediately. Leverage does not simply increase profits. It places an expiration date on your beliefs. In financial markets, being early can look exactly like being wrong. And the winner is not always the person with the smartest prediction. It is the person who can survive long enough to be right.